Yesterday, ladies and gentlemen, we stopped at a very good point where we were handling options, and specifically the currency options. We were handling the currency options. So currency options. So we have here currency. So we have our famous currency, what here? Options. So the currency options, what do we have? And the currency options, if I remember very well, we're doing a past paper question, which was last semester question. And this is what I would want us to finish today. This is what I would want us to finish today. And today I'm lucky because I can now share my screen. All right. Now, currency options are not that straightforward. Many students find them to be quite tough. And what I normally tell people for currency options, just know how to go for the low-hanging fruits. Know how to earn your 2 marks and move on. Don't try to perfect a lot on currency options. Go for the low-hanging fruits, move on. Okay, so here we are. So, ladies and gentlemen, if you look at this particular question that we have here, it was last semester question. Question number 4, cow, where Jaram Limited, which is a UK-based firm, bought goods on credit. So they bought goods on, so they have to pay for them. And these goods are worth what here? 365,000. 365,000 United States. So the most important thing here under currency options, which is Roman number 3, is for us to appreciate, is this a put option or a call option? Is there somebody who can remind us what kind of an option are we going to buy here? What kind of an option are we going to buy here? What kind of an option are we going to buy here? So what kind of an option are you going to buy here? Remember, ladies and gentlemen, that this is a payable. This is the easiest way of you appreciating. And if it's a payable, then just look at it in the normal money markets way. Payables, of course, there is a concept of selling. The bank sells, and a selling option becomes who? A selling option becomes a put option. A selling option becomes a put option. So, ladies and gentlemen, it's payable, yes, it's a put option. Thank you very much. Now, the moment I do appreciate this concept that it's a put option, then I'm at home now. I am at home. So then what I'll do, I'll come and compare two prices here. I'll compare 2 prices here. I'll make a comparison. So for the put option, we have what we call the exercise price. Exercise price in 6 months, when I'll be told to exercise, how much will I earn? Sorry, I did not record. Oh, great. So the better for me, if I've been recording, the better for me. I don't have to start from the beginning. So in 6 months' time, what will happen? I would want to exercise. And when I'm exercising, then what is the exercise price or the strike price? We are told here, there is a place they told us, ladies and gentlemen, for the options. What have they told us for the options? You can see we have an exercise price here. An exercise price is written down here. We have an exercise price, which is $1.4, So we have an exercise price of exercise price of $1.4 per what here? Per pound. Not very clear, but when you see dollars, 1.4, it has to be per unit over the other currency. So it is $1.4, it's here. It's $1.4 per what here? Per pound. $1.4 per pound. That is the exercise. the exercise. And then now you will come and compare this one, like our potatoes, you will come and compare this one with the market price. Market price in 6 months' time. Market price in 6 months' time. So in 6 months' time, what will be the market price of this currency? What will be the market price of this currency in 6 months' time, ladies and gentlemen? If you look at this question, they never gave us the 6 months' time. They never gave us the 6 months' time. Look at this. They never gave us the 6 months' time. They never gave us the market price in 6 months' time. This is a mistake of the examiner. They should have given us this. But now, in the event that you're not given the 6 months market price of this currency, then, ladies and gentlemen, you know, at the end of the day, you have a forward rate, although they don't work together. There's a 6 months forward rate. So there is a 6 months forward rate. Then this 6 months forward rate, what do we have there? 6 months forward rate, I can see the 6 months forward rate, 1.3515. I can see 1.3515. I can see 1.3515. Just giving you how to get the low-hanging fruits. So we have here 1.3515 all the way to 1.3655. And these are what here? Dollars per pound. These are 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 dollars per pound. Now, ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. Normally, you'll be told that you had an option of 2,000 bob for this bag of potato. But 6 months down the line, when you go to Transoia, each bag of potato, you'll get the market selling for you, to you, in this case here, a bag of a potato, say for 800 shillings. Right? So then I'll be able to compare, what is the strike price? What is the options excise price versus the market price? So the market price must be given. But in the event, like in this semester, the examiner does not give you the market price prevailing in 6 months' time. Please go ahead and make use of the forward contract rate. So the forward contract rate has been given like this. But you see, it's given to us in form of a range. So when it is given to us in form of a range, what should we do? Right away, what I'll do, I'll have to select the buying rate. The buying rate, ladies and gentlemen, the home currency here is the pound. The pound is on this other side. The pound is on this other side. So, ladies and gentlemen, the pound being on this other side, could you kindly give me the buying rate? The buying rate here becomes what here? The buying rate becomes what here? The buying. So this becomes the buy. This becomes the buy. And this becomes the what here, somebody? This becomes the sell. Buy and the sell. Buy and the sell. Buy and the sell. So this becomes the buy. This becomes the what here? The sell. Great. So, ladies and gentlemen, so between the two, which rate should we select? Between the two, which rate should we select? Which rate should we select here between the two? Between the two, which rate should I select? Which rate should I select? Remember, it was a payables question. Guys are giving me mixed up answers. Guys are giving me a mixed up answer. It was a payables, it's a payables question. So it's a payables question. So being a payables question really, when it comes in this case here to 6 months, 6 months. When it comes to 6 months, ladies and gentlemen, when it comes to 6 months, what is going to happen here? Pata potea. Pata potea. Most of them are saying 1.3515. Pata potea, pata potea, pata potea. Remember, whatever you have here is a payable question. It's a put question. It's a put question. So in this case here, we are going to sell. So the market price in 6 months, the market price in 6 months here, the market price in 6 months, ladies and gentlemen, of course, it's the bank. The bank will be selling to you this thing at what here? At 1.3515, like that. 1.3515 dollars per what here? Per pound. Thank you very much. Dollars per pound. So I can see Galaxy saying 1.365. Remember, this is what here? It's a payable question. It's a payables question. Can somebody tell us, why do you want us to pick this? These are payables question where you have told us that we are going to do what here at the end of the day, we shall be, not us. When we receive this money, the bank in this case here shall be doing what here from to us, the bank shall be selling. The bank shall be selling. So then the market rate here will be 1.3515 dollars per what here per pound. Kwanza tuko pamoja paka hapo, tu agree kwanza. Tuko pamoja paka hapo. Tuko kwanza pamoja paka hapo kweli. Great. So let us not confuse here really. This is about what here? This is about, ladies and gentlemen, this is about payable. And if it's a payable we know it's sell. So it is a selling rate that will prevail. The selling rate which will prevail. Now, ladies and gentlemen, I would want now us to make a very good argument here. Let's make a very good argument here. What do you think will be better for you? What do you think between the two? What do you think in this case here will be better, the better option for you? What will be the better option for you? Remember, we've got two options here. We have the exercise option at $1.4 equals what here? Equals £1. And then we have the other one, which is the market price, Market price is dollars 1.3515 will give us what here? Will give us £1. What do you think in this case, ladies and gentlemen? Where do you think in this case here are we better off? Where 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 are we better off? Do we exercise the option, or do we have the option lapsing? We work with the market price. So remember, we have the put option. What we have at the end of the day here is called a put option. It's called a put option, which gives us the right, but not an obligation, to sell our own currency. We are going to sell our own currency. So if we sell £1 here, we shall get 1.4. If we sell £1 here, we shall get less. It's a put option. It's a put option. If it was a call option, I would have made your argument of working with this because I'm paying. But remember, what we have, ladies and gentlemen, here is a put option. So for a put option, we shall always go for that particular alternative, which gives us a higher amount receivable. Because put, we are selling. Put, we are selling. Put, we are selling. So for put, we are selling. So in this case, ladies and gentlemen, if for put you're selling, we shall go for the option which will give us the higher amount, So in this case here, we are better off doing what here? Exercising. So in this case here, we shall go for what here? We shall settle for a better rate. We shall settle for dollars. That's $1.4 per what here? Per pound. We shall settle for a higher rate. But now, ladies and gentlemen, listen to me very well. I've always seen students here making what here? Students making arguments. Students will come and say something very nice. Don't write this. Students will come here and say, for example, if I use this rate of dollars 1.4 equals £1, how much will I receive? How much will I receive? How much will I receive? How much will I receive here? How much will I receive? If I use, ladies and gentlemen, the other rate, how much? The most important thing that I'm supposed to really appreciate, ladies and gentlemen, here is that I've been given the option, two alternatives of selling my pound. If I sell my pound for this much, if I sell my pound for using this rate, I'll be fetching 1.4. I'll be fetching 1.4. If I sell my pound, ladies and gentlemen, for this other alternative, I'll be fetching 1.3515. Where will I get more? So what I've seen some good students here doing is just a simple analysis. They'll come and assume, for example, they have some like 20 pounds. So when I have 20 pounds, just an illustration here, when I have 20 pounds and I try using the two alternatives, where will I get more? Where will I get more? Because it's a put option. It's a put option. I'll always go for where shall I fetch more. So in this case here, we're in agreement that this gentleman will be able to fetch more using this. So in this case here, settle for $1.4 per option, i.e. per pound, i.e. exercise, i.e. exercise the right. Exercise, in this case here, the option. Exercise the option. Exercise the option. Great. Now, ladies and gentlemen, the moment I've been able to settle for an alternative, then now everything else becomes very easy. Everything else becomes very easy. Everything else becomes very easy. The next step will be for me to get the number of contracts. So come and give us what we call the number of contracts. Give us the number of contracts. The next step, give us the number of contracts. The number of contracts. So for us to be able to get the number of contracts, the examiner must give us the block size. For us to be able to get number of contracts, ladies and gentlemen, here, for us to be able to get number of contracts, ladies and gentlemen, here, if you look at this question very well, you'll see a place where they're telling you the contract size, the block size, which happens to be pounds what here? Pounds 15,000. Pounds 15,000. So you're told here the foreign currency option prices cents per sterling pound for a contract size of $15,000. $15,000. Now, ladies and gentlemen, everything here becomes quite very easy. How do we get the number of contracts? So we shall look at the amount in question. Amount in question. Divide this by what here? Divide this by the contract size. The contract size. So you take the amount in the question, divide this by the contract what here? The contract size. So is there anybody who is able to see the amount in this question? Is there anybody who is able to see the amount in this question? Is there anybody who is able to see the amount in this question? Is there anybody who is able to see the amount in this question? The amount in this question is $365,000. Divide by the contract size. Contract size, you guys have just given me the contract size, which is what here, somebody? You guys have just given me the contract size, which is 15,000. 15,000 who? 15,000 who? Are they cows? 15,000 who? Are they cows? They are pounds. They are pounds. Now, ladies and gentlemen, listen and listen to me very carefully. In most cases, wanga zinaingiana. Lakini ukiangalia hizi currency haziingiani. So what should we do? Cry? What should we do? Cry? Haziingiani. There must be some conversion to be done. There must be some conversion to be done. There must be some conversion to be done. Yes. So we shall convert one of them at what rate? We shall convert one of them, exchange the 365,000. So exchange the 365,000. So you convert this 365,000 using which rate? 1 point for the one that you got up there. So in this case here, convert the $365,000, convert the $365,000 at 1.4 at $1.4 per pound, at $1.4 per pound, at $1.4 per pound, $1.4 per pound. So in this case here, could you kindly do the conversion for me? I know you guys are experts now. I know you guys are experts. I know you guys are experts. I know you guys are experts. Could you kindly convert for me the three, because there is no way really you'll be able to divide the two if they are of different currencies. If they're of different currencies, you can't. Can you convert for me? Conversion is a low-hanging fruit. Conversion is a low-hanging fruit. So they're telling me it is 260. So what they've done, they have gone ahead and told me, Mwalimu, you know what? This is $1.4 equals £1. Equals £1. Then how about $365,000? How about $365,000? So then this will be 365,000 times 1 over 1.4. So they're giving me a figure of what here, somebody? Please do the conversion for me. 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 They're not giving me the answer. They're not giving me the 260, 714. So we have now 260, 714 pounds divided by 15,000 pounds. You divide this by 15,000 pounds. Divide this by 15,000 pounds. Divide this by 15,000 pounds, which gives us 17.38. Contracts must always be written in as a full number. Contracts must always be written as a full number. So number of contracts will be approximately 17. Number of contracts will be approximately 17. Number of contracts will be approximately 17. So number of contracts here will be approximately 17. Number of contracts here will be approximately 17 contracts. Approximately. Because it has to be a whole number. It has to be a whole number. Great. These are low-hanging fruits. I'm earning some marks there. Low-hanging fruits. I'm earning some marks there. Ladies and gentlemen, listen and listen to me very well. The next thing after I've been able to get these whole number contracts, the next thing will be calculations of the premium that was paid in advance. So the next step will be to calculate the premium paid in advance. Premium paid in advance. So we go to the second last step. Give us the premium paid in advance. Give us the premium paid in advance. So give us here the premium paid in advance. Give us here the premium paid in advance. Premium paid in advance. The premium paid in advance. This is based on the total amount obtained using the actual number of contracts. The actual number of contracts. The actual number of contracts. It's normally based on the total amount obtained using the actual number of contracts. And the actual number of contracts that you guys gave me were 17 contracts. You gave me 17 contracts. You gave me 17 contracts. And you know the value of each contract, don't you? The value of each contract is what here? The value of each contract is 15,000. The value of each contract is 15,000. The value of each contract is 15,000. So 17 times 15,000. This will give me how much, somebody? 17 times 15,000 will give me 260, 255,000. 255,000. 255,000. Thank you very much. 255,000. Are they cows? Are they cows? Are they cows? Pounds, because these are 15,000 pounds. These are 15,000 pounds, like that. Pounds. So then, ladies and gentlemen, could you kindly give me the premium? Could you kindly give me the premium? So therefore, the premium here will be the 255,000 pounds, the 255,000 pounds times the premium rate, times the premium rate of put options, the premium rate of put options, times the premium rate of put options. So the premium rate of put options, is there somebody who can see the premium rate of put options? Is there somebody who can see the premium rate of put options? Is there somebody who can see the premium rate of put options? Is there somebody who can see the premium rate of put options? premium rate of put options, premium rate of put options, premium rate of put options. They are not saying it's 9.5, right? It's 9.5 years. So it will be 9.5. So times 9.5 over 100 times 9.5 over 100 times 9.5 over $100 per pound. Is there somebody who can tell me, why do you think am I dividing this by 100? Why do you think am I dividing this by 100? Where am I dividing this by 100? Cents, yes. Premium. Premium is always given in form of cents. Premium is always given in form of cents. They've told us here, cents per pound. You can see the foreign currency option prices, cents per sterling pound, right? And then you can see we decided to pick the one of 6-month put option, not call option, because we have a put option here, which is what here? 9.5. So 9.5 cents per whatever, we want those cents to be dollars. So 9.5 divided by 100. So then could you kindly go ahead? Could you kindly go ahead and give me, could you kindly go ahead and give me, kindly go ahead, and then you give me the figure here, the premium paid in advance. The premium paid in advance. So it is 24, 22, I don't know who is telling me the truth. 24 to 25. So we have here 24, 225. 24, 225. Are they cows? Are they cows? What are they? What are they? Are they cows? What are they? Are they cows? Are they cows? No, they are pounds. How can they be pounds? And you can see pounds and pounds here cancelling. All right. Pounds and pounds, they are cancelling. Pounds and pounds, they are cancelling. So then at the end of the day, whatever shall be getting here will be dollars, dollars, dollars. But you see now, I would want these figures here to be in terms of my home currency. I would want these figures to be in terms of my home currency. So could you kindly find a way of converting this premium? Convert this to pounds. Convert this to pounds. So could you kindly convert this to pounds? Could you kindly convert this to pounds? Could you kindly convert this to pounds? And again, remember that premium is paid in advance. So the exchange rate has to be done using what here? The spot rate. The exchange rate has to be done using the spot rate. So use the spot rate. So exchange at spot. Exchange at spot. Exchange at spot. Exchange at spot. So when you go exchanging at spot, ladies and gentlemen, are you able to see the spot rate? 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 These students are not able to see the spot rate. They are not able to see the spot rate. They are not able to see the spot rate. They are not able to see the spot rate. I'm able to see the spot rate up there, which is 1.3648 all the way to 1.3722 dollars per pound. Great. So between the two, ladies and gentlemen, the spot rate here, could you kindly tell me which one is the buy, which one is the sell? Which one is the buy, which one is the sell? Which one is the buy and which one is the sell? Kindly advise. Kindly advise which one is the buy, which one is the sell. Kindly advise. Right. So remember, the pound is your home. The pound is your home. So buy. So this is buy and this is sell. So in this particular case here, which figure are we going to use? Which figure are we going to use? Which figure are we going to use? Because we can't use both. Lakini kichanganyiko kwa exam, unatumia ile what if analysis. If I use this, if it's allowed, right? So which figure am I going to use here? So most of them are saying selling, selling, selling. But don't forget that this one at the end of the day is a premium that you are paying yourself. It's a premium that you are paying yourself. It's supposed to be a payable amount. This is supposed to be a payable amount. And for payable, what will happen? For payable, what will happen? For payable, what will happen? You guys are right. For payable, it becomes what? It becomes a sale. So for payable, it becomes a sale. Yes. So this is the figure that I will settle for. So this is the figure that I will settle for. This is the figure that I will settle for. All right. This is a figure that I will settle for. So please go ahead and exchange this premium. So go ahead and exchange the premium. 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 So we have here 1.36. So we have here 1.3648 dollars equals £1. How about 24? Was it 24? I've forgotten the figure you guys gave me. Why did I rub my figure? Why did I rub my figure? Was it 24? Was it 24? 24? 24? What was it? Somebody remind me. Some of that figure. Remind me the figure. Remind 24 to 25. Thank you very much. 24 to 25. 24 to 25. 24 to 25 dollar equals to who? So I can suspect Rose, you must have done it wrongly, Rose. Rose, please. Rose, please. Always do this kind of an expression for you to know whether, even Jamie, you can see now what is happening. Students are using a bad approach. All right. So in this case here, when I cross multiply, I don't multiply really this and this. No, it will be dollar times dollar, which will be dollar squared. That will be quite absurd. That will be quite absurd. It should be 24 to 25 times 1 divided by 1.3648, which will end up giving us what figure? 17,750. 17,750 pounds like that. Pounds like that. Now, the moment I've gotten a premium, I don't even have to continue. I've gotten all the marks. Actually, very few students will reach here. The examiner will always say that somebody who has been able to get the premium, just award all the marks, award all the marks. So then we have 17,750 pounds like that. So the last step will be for you to come and give us the net amount. The net amount. So the net amount, what will happen in 6 months? In 6 months, my put contracts. In 6 months, my put contracts. In 6 months, my put contracts will give me in six months. If I sell my put contracts, you guys had given me a figure. Was it 255,000 pounds? My put contracts will give me 255,000. And then less the advance paid, less the premium paid in advance. Premium paid in advance, less the premium paid in advance, which is 17,750 pounds. I'm able to get the net amount. 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 So is there somebody who can give us that net amount? So I'm able to get that net amount very easily. I'm able to get the net amount very easily. I am able to get the net amount very easily. I'm able to get the net amount very easily. I'm able to get the net amount very easily, which gives us 278, 237. They're getting 237. Remember, actually this is wrong. This is wrong. This is wrong. Even the examiner here is wrong. Because, you know, the net amount is supposed to be what here? The premium. You paid it up front. It's supposed to be negative. The premium is supposed to be negative. It's supposed to be negative. Here, when I sell the put contracts, I'm getting an income. And then the premium amount, I'm getting 17,750 pounds, which is supposed to be a payable. I paid for that. I paid for that in advance. So I'm supposed to less, which will end up giving me what figure, somebody? which will end up giving me what figure? Somebody, which will end up giving me what figure? Somebody, which will end up giving me what figure? Is there somebody who is, it can be seen. You mean 237? So you can see the examiner